If you're watching this video, you probably already know that you should be investing in the stock market, and you probably already know that ETFs should make up the bulk of your portfolio. With that said, there are hundreds, if not thousands of ETFs out there, so it can get really confusing and tiring trying to narrow down which ones are the best to add to your portfolio. So what I want to do in this video is I want to give you 3 that should really help you narrow down that search. These are proven ETFs that are held by many investors, and they should make consideration for your portfolio as well. Now, before we begin, I do want to go over one thing. When it comes to your portfolio, there are really 2 main things that you are trying to accomplish. Either A, you are trying to build a portfolio and a net worth for retirement, or you might be potentially after passive income. And depending on which one of those you lie on, which side you lie on, your approach is going to be different. Because if you are trying to plan for retirement, what you care about more than anything else is stability and year-over-year return, regardless of whether that return comes from dividends or just the return, the appreciation of the actual asset. Now, on the flip side, if you are after passive income, then the dividend return is going to be much more important for you, as well as the total return, because you are trying to live off of your investments. So dividends become very important. So when you're putting your portfolio together, plan accordingly. Okay, now let's get into these 3 that I think are really good and can make up a good portfolio for pretty much any investor out there. The first is, of course, the VOO. Now, the reason why I like the VOO is because it is a simple S&P 500 tracking fund. And as you may know, the S&P 500 and a fund that tracks that should make up the bulk of most people's portfolios. Why? Well, because diversification is pretty much built in. When you have something like that is tracking the 500 largest US companies, you basically have guaranteed diversification. So if some companies suffer, you have 500 companies that you're spreading your risk over. Now I want to go over the numbers. This tracks the overall S&P 500, and it has an expense ratio of 0.03%. Remember, funds do take a small portion to cover costs, etc. 0.03% is very low. Now, what makes funds, ETFs in particular, much better than, say, mutual funds is that the expense ratio is much smaller. So 0.03%. Now, the average 30-year return on the VOO is about 9.74%, and that is compounding. So that is really good, and it will lead you to a very healthy retirement if you start investing early in the VOO. Now, I do want to give you an alternative just for whatever reason. If you don't like the VOO, if you don't like Vanguard, etc., a good alternative is the SPY. It does a very similar thing, although the VOO slightly outperforms it usually. Okay, so that's the first one. This should make the bulk of your portfolio. The second is a dividend-specific ETF. This is good for both retirement planning as well as passive income generation. But of course, if you are after passive income generation, then you're going to want a large portion of your portfolio potentially to make or to be made up by dividend-producing assets. Okay, that means dividend-producing stocks, real estate, as well as dividend-producing ETFs. The SCHD is an excellent one. It's owned by Schwab, and I want to go over the numbers for you just so you have a general understanding of what it does. So first and foremost, it tracks the Dow Jones US Dividend 100 Index. Okay, this is an index that tracks 100 large dividend-producing companies. All right, we can go more in depth, but I want to make this as simple as possible for most people. Now, the expense ratio of this is 0.06%, so it's slightly higher than the VOO, but you're also getting dividend returns. Now, I want to go over the average 10-year return for this, as well as the average dividend return. So the average 10-year return is 11.7%. So compare that to the VOO. It returns slightly higher than the VOO, but the VOO is tracking over a 30-year period. This is data over the last 10 years. If you did the VOO over the last 10 years, the return would be significantly higher. So just understand that. Now, the average dividend return, which is what's important to dividend investors, is 3.5%. That means every year you'll get 3.5% of whatever you invest in. And of course, this changes slightly higher, slightly lower, but that is a solid dividend return, especially when you are compounding this over time. Now, I also want to give you an alternative. A good alternative is the NOBL, but most people are going to probably push more to the SCHD just for risk factors primarily. So far we have a good general broad-based ETF, which is the VOO. This tracks the overall market, and it is a good, solid performer. The second is a dividend specific one, which is the SCHD. Now our alternatives are the SPY and the NOBL. Now the third one that I want to go over is what's known as a sector ETF. This tracks a specific sector, and there are ETFs for many, many sectors in the market. Energy, tech, dividends, etc. All these are sectors, right? So the one that I want to go over is one that tracks the tech sector. Now, tech has, in very recent history, kind of stumbled a little bit, but over the long term, tech tends to lead the overall market. So when you look at a tech specific ETF, what you are getting is you are getting slightly higher risk. So that is something that you need to factor in. But because why? Well, tech companies are in general more risky because they make a lot of money, but they can also lose a lot of money. They're also not mature companies. A lot of the times they are shorter companies in lifespan, or startups, or much younger companies. So keep that in mind. But in my opinion, when it comes to the tech sector, VGT is a great one. Again, a Vanguard fund, and this tracks technology in general, which is why the return is high. Now, the expense ratio is also slightly higher at 0.1%. So it is the highest expense ratio out of the three that we're talking about, not including the alternatives. But the average 10-year return on the VGT is 19%. Okay. Now I could go a little bit more into detail, but I want to keep this video simple. What I'm going to say is when you look at the standard deviation for that return, it is going to be greater than the other two. Standard deviation can also be equated as risk. It is a riskier asset because it is tracking a riskier basket of assets. Okay. Riskier ETF because it tracks the tech sector. With that said, if you have a higher risk tolerance or you have a longer time horizon, this could be a good bet because you have more time to recover losses. If you have a shorter time horizon or you are potentially going to be living off of the income from these assets, then you might want to make this a smaller portion of your portfolio. As always, this is not financial advice. You should know that by now. I'm just someone on the internet, and you should always do your due diligence, regardless of whether I have a degree or not, regardless of my experience or not. You have to understand these are my opinions, and it is always, always important for you to do your due diligence. And I don't want to get too much into that, but this is a good, I'm just going to digress just for a second. You have to do your own due diligence because there are many, many good ideas out there. But what's a good idea for me or for somebody else might not be a good idea for you based on your risk tolerance, your age, and your situation. You might have kids, you might not. You might live in a very inexpensive state or you might live in a very expensive state. All these different things matter when it comes to your situation and what you should be investing in. So either do your own due diligence or talk to a financial advisor or do both. It's very, very important. Remember, people throw this under the rug, but your financial future is your future. Unfortunately, we live in a world where money matters. So if you want a better financial future, you have to take this stuff seriously. Okay? All right. I don't want to spend too much time on that. The only thing I want to do is for the VGT, I want to give like an alternative, but this is also like a bonus. Okay? Because although it is not a direct competitor to the VGT, it does track similar stocks, and that is the QQQ. The QQQ tracks the NASDAQ 100. Okay, the NASDAQ 100 is the 100 largest non-financial companies. The reason why it is similar to the VGT, it's not exactly the same, and I don't even want to say it's similar, but heads down the same path, primarily because when you remove financial companies and you do the largest 100 companies, a lot of those companies are going to be tech companies anyway. So QQQ, VGT, very similar. One tracks tech, one sort of tracks tech, at least currently. Now, if we move to the future in 10, 20 years from now, the 100 largest companies are not tech anymore. Maybe it is agriculture, or maybe it's space travel, whatever it is in the future. If the largest 100 non-financial companies change from tech, then of course the QQQ will follow that. But currently, the largest 100 companies, a lot of them are tech companies when you remove financial companies. So I hope this list was helpful. I hope this video was helpful. I hope this video wasn't too long. I wanted to just get right to the point and give you the numbers as well as the ETFs to help you narrow down your search. Hopefully this did that. Again, it is the VOO, overall S&P 500 tracker, the SCHD, which is a good quality dividend returning ETF, the VGT, which is a sector ETF. It tracks tech. Now, if you think that other sectors are going to do good in the market, look for other sector ETFs. Okay, and then the alternatives are the SPY, also tracks the S&P 500. The NOBL, also a dividend returning ETF, it tracks the aristocrats, dividend aristocrats. Okay, these are established companies that have increased dividends. And the last, which is like an alternative slash bonus, is the QQQ. It does not track the S&P 500. It also does not technically track tech, but it kind of sort of tracks tech because it tracks the 100 largest non-financial companies. All right, I hope this video was helpful. If it was, please consider subscribing. This is a brand new YouTube channel, and it is something that I'm very passionate about. I got my degree in finance, so you don't have to, but I also got my degree in finance because this is something that I'm very, very passionate about and I love to share with others. So if you like personal finance, if you like investing, if you like world economics, if you like anything else that relates to that, money, etc., you're in the right place, and I hope to see you in the next video. Other than that, I hope you guys have a great rest of your day. I hope you have a great rest of your week, and I will see you in the next video. Take care.